Before we dive in, let's get the important legal stuff out of the way. I am not a financial advisor, a loan officer, or an attorney. This presentation is for informational and educational purposes only. The information provided is not intended to be a substitute for professional financial or legal advice. You should always consult with a qualified professional before making any major financial decisions, especially one as significant as purchasing a home. All examples are hypothetical and for illustrative purposes. Your individual situation is unique, and the mortgage process can vary significantly based on your circumstances, location, and the lender you work with. Imagine this for a second. You've done everything right. You've worked hard, you've saved up a down payment, maybe $20,000, $50,000, even $100,000. You have a stable job with a good income. You pay your rent on time every single time. You pay your cell phone bill, your car insurance, your utilities like clockwork. You live within your means. You've intentionally avoided credit cards and student loans because you're responsible, you hate debt. You are the poster child for financial discipline. So you find the perfect house. It's in a great neighborhood, the right size for your family. You can practically hear your kids laughing in the backyard. You've done the math, you can easily afford the monthly payment. You walk into a bank, confident, prepared, holding a folder thick with pay stubs and bank statements. You sit down with the loan officer, lay it all out, and you see them nodding. Everything looks great. Then they pull up your information on their computer. Their smile fades just a little, and they turn the screen towards you. In the box labeled credit score, it just says, not applicable. And the loan officer looks at you with a mix of pity and confusion and says the words that shatter your dream. I'm sorry, we can't help you. The system requires a credit score. Without one, you don't exist to us. Feels like a punch to the gut, a slap in the face. All that hard work, all that discipline, all that saving, and you're rejected. Not because you're a risk, but because you refuse to play a game you didn't want to be a part of. You're being punished for being responsible. If that story hits a little too close to home, or if that's the exact nightmare scenario you're trying to avoid, then you are in the exact right place. Because I'm about to tell you something that most banks and mortgage brokers won't. That entire scenario is built on the single biggest myth in the American real estate market. The myth is that you absolutely need a FICO score to qualify for a mortgage. It is simply not true. In this video, I am going to give you the complete step-by-step blueprint for buying a home in the United States with zero credit score. This isn't some theoretical concept or a weird loophole. This is a well-established, legitimate process used by thousands of people every single year to achieve the American dream of homeownership. We are going to tear down the myth piece by piece and replace it with a practical, actionable battle plan. You will learn what the banks don't want you to know, how to build a financial profile that's even more powerful than a 3-digit number, and exactly how to find the lenders who are equipped and willing to look at you as a person, not just a score. So who is this for? This is for the young person fresh out of college who has a great job but hasn't had time to build a credit history. This is for the immigrant who is building a new life in America with a solid income and savings, but whose financial history from their home country doesn't translate into a U.S. credit score. This is for the couple that got serious about their finances, cut up their credit cards years ago, and live a proud, debt-free life. This is for anyone who has been told they are a ghost in the financial system. And you are not alone. Not by a long shot. According to the Consumer Financial Protection Bureau, over 26 million American adults are credit invisible. That means 1 in every 10 adults in this country has no credit history with any of the 3 national credit reporting agencies. Another 19 million have a credit file that is so thin or stale that it's unscorable. We're talking about 45 million people who are locked out of the traditional system, many of whom are perfectly capable and deserving of owning a home. The problem isn't you. The problem is a system that has become lazy, a system that has become addicted to the convenience of a single number. The FICO score was invented in 1989. Think about that. People were buying houses for centuries before a FICO score ever existed. How did they do it? They did it through a process called manual underwriting. And that right there is the secret key that is going to unlock the door to your new home. Manual underwriting is exactly what it sounds like. Instead of a computer algorithm making a split-second decision based on your credit score, an actual human being, an underwriter manually reviews your entire financial life. They look at the real story. They look at your income stability. They look at your savings, your assets. And most importantly, they look at your history of making payments on time for your recurring bills. They build a picture of your financial character, your reliability, based on real-world evidence, not just a history of borrowing money. This process is more work for the lender, which is why many of them don't like to do it or advertise it. It's easier for them to just plug a number into a computer and get a yes or no. But for you, the credit-invisible homebuyer, manual underwriting is your golden ticket. It allows you to prove your creditworthiness using what we call non-traditional credit or alternative credit. What does that mean? It means your documented, on-time payment history for things that don't typically show up on a credit report. The biggest and most powerful one is your rent. If you can provide 12 to 24 months of canceled checks or bank statements showing you paid your landlord on time, every single month without fail, that is a massive piece of evidence. That payment is likely as large or even larger than your future mortgage payment. It proves you can handle that level of financial responsibility. But it doesn't stop there. We're talking about your utility bills, electricity, gas, water, internet. We're talking about your cell phone bill, your car insurance payments, your renter's insurance, even regular payments to a daycare or tuition for your kids' school. When you bundle these payment histories together, you are creating a portfolio that tells a story. It's a story of consistency, of reliability, of honoring your commitments. It's a story that, for the right lender, is far more compelling than a simple credit score ever could be. So the game plan is no longer about trying to quickly get a credit card to generate a score. That's the wrong approach and often backfires. The game plan is to meticulously document the responsible financial life you are already living. We're going to shift your mindset from, I have no credit, to, I have a powerful, alternative credit history, and I just need to learn how to present it. Throughout this video, we're going to break it all down. We'll cover the specific types of loans that allow for manual underwriting, like FHA, VA, and certain conventional loans. We'll create a detailed checklist of the exact documents you need to start gathering right now, today. I'll show you how to find the right kind of lender, the mortgage brokers and community banks that specialize in this, versus the big box banks that will just show you the door. And I'll give you the exact language to use when you first speak to a loan officer, so you sound like an expert and are taken seriously from the very first conversation. You are not a ghost. You are not a risk. You are a responsible person who has been overlooked by a flawed system. And by the end of this video, you will have the knowledge and the confidence to walk past that system and straight into the front door of your own home. Let's get started. First, we need to understand the battlefield. Why does this problem even exist? Why does a system designed to measure financial responsibility completely ignore millions of responsible people? The answer is simple and a little infuriating: efficiency. The modern lending world is built on algorithms. It's a giant automated machine that sorts people into boxes based on a single number, your FICO score. If you have a good number, the machine says, yes. If you have a bad number, it says no. But what if you don't have a number at all? The machine just short circuits. It spits out an error message. It labels you credit invisible. And to the machine, invisible is the same as unworthy. This isn't some tiny niche problem. According to the Consumer Financial Protection Bureau, roughly 26 million Americans are credit invisible. That's 1 in 10 adults. Another 19 million have a credit file that's so thin, it's considered unscorable. Add it all up and you're looking at 45 million people, a population larger than the entire state of California, who are being completely shut out of the traditional credit system. 45 million people who pay their bills, manage their money, and dream of owning a home, but are told no by a computer before a human ever even looks at their file. You might be one of them for a perfectly logical reason. Perhaps you're a follower of financial gurus like Dave Ramsey. You've been taught that debt is dumb, that cash is king. You've diligently paid for everything with money you actually have. You cut up your credit cards years ago. You saved, you sacrificed, you built a solid financial foundation. And your reward for this incredible discipline? The system penalizes you. It sees your lack of debt not as a sign of responsibility, but as a blank page, void of data. Or maybe you're new to the country. You've come to the United States to build a new life, bringing your work ethic and your dreams with you. But your financial history from your home country doesn't transfer over. To the American credit system, your past doesn't exist. You're starting from absolute zero, no matter how successful or responsible you were before you arrived. Maybe you're young, just starting your career. You've been focused on school, on landing that first job. You haven't had the chance or the need to take on debt yet. Or perhaps you've been a stay-at-home parent, and all the household credit has been in your spouse's name for the last decade. In all of these scenarios, the outcome is the same. You are financially responsible, but you are also a ghost in the machine. So how do we fight a machine? You don't. You bypass it. You find the human being behind the curtain and you make your case directly to them. This process has a name, and it is the single most important term you will learn in this entire video: manual underwriting. Write it down. Say it out loud. Manual underwriting. This is your key. This is your secret weapon. Think of it this way. The standard mortgage process, the one that relies on credit scores, is like an automated bouncer at a nightclub. It's a cold metal gate with a scanner. The scanner only checks for one thing: a VIP ticket, which is your credit score. If you have the ticket, a score of say 640 or higher, the gate swings open. If you don't have the ticket, the gate stays shut. It doesn't care that you're well-dressed, that you're a friend of the owner, or that you have more than enough money to buy the whole bar. No ticket, no entry. End of story. That's the automated system. That's the machine that's been telling you no. Manual underwriting is different. Manual underwriting is walking past that cold metal gate, finding the club manager, and having a conversation. The manager isn't looking for a ticket. They're looking at you. They're using common sense. They'll ask you, can you afford to be in here? Are you going to cause any trouble? Can you prove that you're a responsible person? Instead of showing them a ticket, you show them your proof. You show them your pay stubs that prove you have a stable job. You show them your bank statements that prove you have a history of saving money. You show them records of your rent payments that prove you have a perfect decade-long history of paying your biggest bill on time every single time. The manager looks at all this evidence, this real-world proof of your financial character, and makes a human judgment. They see the full picture, not just a single 3-digit number. They see a reliable, low-risk person who just happens to not have the specific ticket the automated gate was looking for. And they say, welcome. Come on in. This is not a loophole. This is not some shady back alley deal. Manual underwriting is a long-standing, legitimate process that many lenders are equipped to do. It's how all mortgages were approved before the invention of credit scores and computer algorithms. It's simply fallen out of favor because it takes more time and more effort. It requires a loan underwriter, a real person to sit down, look through your documents, and use their brain to assess your risk. The machine is faster. The machine is cheaper. But the machine is dumb. It lacks nuance, context, and common sense. Our entire strategy is to sidestep that dumb machine and present your case to a smart, reasonable human being. To do this, you need to fundamentally shift your mindset. You are not a charity case. You are not asking for a favor. You are not less than a borrower with an 800 credit score. You are a prime borrower with an unconventional data set. Your financial story isn't written in the language of FICO, Visa, and MasterCard. It's written in the language of rent checks, utility bills, insurance premiums, and consistent savings. Our job is to translate your story into a language the lender can understand and accept. We do this by building what's called an alternative credit history. It's a portfolio of your financial life, a collection of documents and records that, when put together, paint a powerful picture of reliability, a picture that is often even more compelling than a traditional credit report. A credit report shows how you handle debt. An alternative credit history shows how you handle life. It shows you pay for the roof over your head. It shows you keep the lights on. It shows you plan for the future. Which one do you think is a truer measure of a person's character? So where do we begin? How do you start gathering the documents to build this powerful portfolio? We start with the most important piece of evidence in your entire arsenal. It's the one payment you've likely been making consistently for years, the one that most closely mimics a mortgage payment itself. I'm talking about your rent. We are going to take your simple history of paying rent and turn it into the undeniable cornerstone of your mortgage application. We are going to prove to the lender that you have already been paying a mortgage, you've just been paying it to your landlord. And now you're ready to start paying it to yourself. So let's talk about how we do that. How do we take something as simple as your monthly rent check and forge it into the single most powerful weapon in your mortgage application arsenal? The answer lies in a process that most people have never even heard of. It's called manual underwriting. You see, when you have a high credit score, your application gets fed into a computer. An algorithm looks at your score, your debt, your income, and spits out a simple yes or no. It's fast, it's efficient, and it's completely impersonal. But when you have no credit score, you get something far more valuable: a human being. A manual underwriter is a real person whose job is to look beyond the numbers and see the story. They are the judge and jury for your loan, and our job is to present them with a case so compelling, so airtight, that they have no choice but to approve it. And the star witness in this case? Your rental history. We are going to prove beyond a shadow of a doubt that for the last 12 and ideally 24 months, you have consistently paid a large housing-related bill on time every single time. This starts with the paper trail. The absolute gold standard for proving your rent payments is a clear, unbroken chain of canceled checks or bank statements showing automatic transfers. Why? Because it's undeniable. A bank statement showing a $1,500 transfer to Maple Street Properties LLC on the 1st of every month for 2 years is a prosecutor's dream. There's no ambiguity. It shows the amount, the date it was sent, and who it went to. If you pay your rent this way, you are already halfway to the finish line. Your first step is to log into your online banking portal right now and download the last 24 months of statements. Save them as PDFs in a dedicated folder on your computer labeled Mortgage Documents. Now, what if you pay with a money order? This is the silver standard. It's workable, but it requires more diligence on your part. You absolutely must have the receipts for every single money order you've sent for the last 12 to 24 months. These receipts, combined with bank statements showing the cash withdrawal to purchase the money order, create a credible link. It's not as clean as a direct transfer, but a meticulous stack of receipts shows the underwriter you are organized and responsible. And then there's the danger zone cash. If you pay your landlord in cash, from an underwriter's perspective, those payments might as well have never happened. There is no third-party verification. It's your word against the void. If you are currently paying in cash and want to buy a house in the next 2 years, you need to stop. Today, talk to your landlord. Explain that you need to build a financial record for a future home purchase and you will now be paying by check, direct deposit, or at the very least a cashier's check. This single change is the most important thing you can do to prepare for a no-score mortgage. Start building that paper trail now because you can't build it retroactively. Once you have your proof of payment, we need to pair it with official verification from your landlord. This comes in the form of a document called a verification of rent, or VOR. This is a standard form that the lender will send to your landlord, or ask you to have them fill out. It asks simple questions. What is the monthly rent? What is the address? And most importantly, in the last 12 months, how many times was the rent paid more than 30 days late? The goal here is a big fat zero. Now, a common fear is, what if my landlord is a private individual, not a big company? What if they're difficult to deal with? This is a valid concern, but it's easily managed. First, give them a heads up. Let them know a form will be coming, and that it's a critical part of your ability to buy a home. Frame it as a favor that helps you achieve your dream. Second, make it easy for them. Offer to pick up the form, pre-fill your information, and even include a pre-stamped envelope addressed back to the lender. The easier you make it, the faster you'll get it back. Your VOR, combined with your 12 to 24 months of canceled checks, is the 1-2 punch that makes your housing payment history undeniable. But we can't stop there. A single witness, even a star witness, isn't enough to win the case. We need a supporting cast. We need to build what's called an alternative credit portfolio. This means providing proof of on-time payments for other recurring bills, again, for the last 12 to 24 months. Think of your monthly expenses. We're looking for at least 3 to 4 additional accounts. The most powerful are your utilities, your electric bill, your gas bill, your water bill. These are fantastic because, like rent, they are tied to a physical address and demonstrate your ability to maintain a household. Call your utility providers or log into their online portals. Ask for a letter of credit or a payment history ledger. This is a document they can produce that shows your entire payment history on one page. Every payment date, every amount, and any late payments. Again, we're shooting for a perfect record. Next up, your communication bills. Your cell phone bill is a perfect example. Most people have had the same provider for years. Getting a payment history from them is usually a simple phone call away. The same goes for your internet or cable bill. These monthly payments show consistency and reliability. Then we have insurance. Car insurance is a big one. It's a mandatory payment for most people, and showing that you've paid it on time every month without fail is another strong signal to the underwriter. Renter's insurance is also excellent, as it's directly related to housing. Once you have these core accounts, rent, utilities, phone insurance, you can level up your portfolio. Do you make regular on-time payments for childcare? Get a letter from the daycare provider confirming your payment history. Do you pay for tuition? Get a statement from the school. Do you have a gym membership that gets auto-debited every month? print the bank statements showing those payments. The key is to think like an underwriter. They are looking for patterns. They are trying to answer one fundamental question. Does this person have a demonstrated history of honoring their financial commitments? Every single document you provide, every canceled check, every utility ledger, every insurance statement, is another piece of evidence. You are methodically, systematically removing all doubt from their mind. You're showing them that the absence of a FICO score isn't a sign of irresponsibility. On the contrary, you are proving that you are so responsible, so consistent, that you've managed your entire financial life without ever needing to rely on the traditional credit system. You are building a fortress of financial proof, brick by brick. Gather these documents. Create that folder on your computer. Download the statements, make the phone calls, and get your letters of credit. This is the work that separates the dreamers from the homeowners. This portfolio is your story, told through the language of financial transactions. It proves you're not a risk, you're a sure thing. Now that we've established the undeniable proof of your payment history, we have to tackle the other giant pillar of a mortgage application. The money, the down payment and closing costs. It's not enough to just have the cash. Where it came from, how it got into your account, and how you document it can be the difference between an approval and a soul-crushing denial. And that's exactly what we're going to break down next. How to source, season, and document every single dollar so that it sails through underwriting without a single red flag. Think of your bank account as the financial story of your life. When you apply for a mortgage, an underwriter, the person who actually approves or denies your loan, becomes the most critical reader of that story. They're looking for a narrative of stability, predictability, and responsibility. A large unexplained cash deposit a week before you apply is like a crazy plot twist in the final chapter that makes no sense. It screams risk. It could be a loan from a shady relative that you have to pay back, an illegal side hustle, or worse. Lenders hate plot twists. They want a boring, predictable story. This is the entire concept behind sourcing and seasoning your funds. Seasoning is just a fancy industry term for letting your money sit in your bank account for a period of time, typically 60 to 90 days. Why? Because that 2 to 3 month window is usually what lenders require for your bank statements. Any money that has been in your account for that entire period is considered seasoned. It's considered your money free and clear. Anything deposited more recently is unseasoned and will be scrutinized. The lender needs to verify its source to ensure it's not a secret, undisclosed loan that could affect your ability to repay the mortgage. So let's break down exactly how to build that perfect paper trail for every dollar you plan to use, starting with the easiest and moving to the most complex. The gold standard, the absolute cleanest source of funds, is your own paycheck, direct deposited into your bank account. If your entire down payment and closing costs have been saved up over time from your regular job, and it's all sitting in a savings or checking account, you're in fantastic shape. The underwriter will see your pay stubs, see the corresponding deposits on your bank statements, and it's a simple, clean line. Checkbox ticked. No questions asked. This is the dream scenario. But for many people, it's not that simple. Let's talk about the biggest red flag of them all: cash. Mattress money. Maybe you saved tips from a restaurant job, or you sold items for cash, or you just don't trust banks. Whatever the reason, you have a shoebox with $10, $20, or even $50,000 in it. Your first instinct might be to walk into the bank and deposit it all at once so you can get the loan process started. Do not do this. I repeat, do not do this. A large cash deposit is the financial equivalent of a nuclear bomb going off in your application. First, any deposit over $10,000 in cash automatically triggers a report from the bank to the IRS to combat money laundering. That alone puts you on a list you don't want to be on. But for the mortgage underwriter, it's an unsolvable mystery. They cannot source it. There is no paper trail for cash. They have to assume the worst-case scenario, that it's a loan you'll have to pay back. And since they can't prove otherwise, they will likely deny your entire mortgage application on the spot. So what's the right way to handle cash? The only answer is time. You need to deposit that money into your account and let it season. If you need the money for your down payment within the next 2 or 3 months, you have a serious problem. But if you're planning ahead, you can deposit the cash and wait a full 90 days. After it has sat in your account for 3 full months and appears on 3 consecutive bank statements, it is now considered seasoned. It's part of your established financial history. The underwriter might still ask for a letter of explanation, where you state in writing that the funds were from accumulated personal savings, but because it's seasoned, it's no longer the deal-killing red flag it would have been. The key is planning. Next up, a very common and wonderful source of funds: a gift from a relative. Parents or grandparents often help with a down payment, but you can't just have them wire you $20,000 and call it a day. This requires a specific, rigid documentation process. First, you need a gift letter. This isn't a Hallmark card. It's a formal document that must contain very specific information: the donor's name, address, and phone number, their relationship to you, the exact dollar amount of the gift, and most importantly, a sentence that explicitly states, "This is a bona fide gift, and there is no expectation of repayment, expressed or implied." Both you and the donor must sign and date this letter. But that's only step one. You also have to prove the donor had the funds to give. This means the donor must provide a copy of their bank statement showing they had the money in their account before they gave it to you. Then you need to show the money trail. This can be a copy of the canceled check from their account or a wire transfer receipt. Finally, you need to provide your own bank statement showing the funds being deposited into your account. You have to connect all the dots for the underwriter. Here's the letter saying it's a gift, here's proof the donor had the money, here's proof it left their account, and here's proof it arrived in mine. It feels invasive, but without this complete paper trail, that gift money is unusable. What if you sold something valuable to raise cash, like a car, a boat, or some jewelry? This is perfectly acceptable, but again, it's all about the paper trail. You need to create a clear story. Let's say you sell your classic car for $30,000. You will need a copy of the vehicle's title in your name to prove you owned it. You'll need a formal bill of sale, signed by both you and the buyer, detailing the vehicle, the sale price, and the date. And you'll need proof of payment. A copy of the cashier's check or a wire transfer receipt is best. You then deposit that check and provide the bank statement showing that exact amount entering your account. You're showing the underwriter, "I own this asset, I sold it for this much, and here is the money in my account." It's a clean, verifiable transaction. Another common source is a loan or withdrawal from your 401k or other retirement account. This is one of the few times where getting a loan to help with your down payment is okay, because it's a loan from yourself. To document this, you'll need to provide the terms and conditions of the loan or withdrawal from your retirement plan administrator. This paperwork will show the total amount you're taking out, and if it's a loan, what the monthly repayment terms are. The underwriter needs this for two reasons. First, to verify the source of the funds, and second, to include that new monthly payment in your debt-to-income ratio calculation. It's a straightforward process, as long as you provide all the official paperwork from your 401k provider. Now let me give you the single best piece of advice for managing all of this. Create a dedicated mortgage savings account at least 6 months before you plan to apply. Use one single account for all your down payment and closing cost funds. Funnel your payroll savings into it. If you get a gift, have it deposited there. If you sell an asset, put the money there. Do not commingle your daily coffee and grocery money with your huge down payment fund. And absolutely do not start shuffling large sums of money between your checking, savings, and investment accounts in the months leading up to your application. This creates a tangled web of transfers that underwriters have to spend hours unraveling, and it makes them nervous. A clean, separate account with clear, documented deposits tells a simple story. It says, "I am organized, I am financially responsible, and I have been planning for this." For a manual underwriter who can't rely on a credit score, this visual proof of your financial discipline is incredibly powerful. It builds trust. It shows them you're not a risk. You're a responsible future homeowner. You're handing them a neatly organized binder instead of a shoebox full of crumpled receipts. Getting your money sourced and seasoned is not just a suggestion. For a no credit score loan, it is the bedrock of your entire application. But having the money is only half the battle. You also have to prove you have a stable, reliable, and sufficient income to make the monthly mortgage payments for years to come. And if you're self-employed, a freelancer, or work in the gig economy, proving that income is a completely different challenge. That's where we're going next. How to document every dollar of your income, no matter how unconventional, to satisfy even the most skeptical underwriter. For a salaried employee with a W-2, proving income is like handing a lender a photograph. It's a single, clear snapshot in time. But for the self-employed, the freelancer, the small business owner, it's not a photograph. It's a 1,000-piece puzzle scattered across a table. Your job isn't just to show the lender the finished picture. It's to hand them every single piece, in the right order, with a map explaining how they all fit together. The underwriter isn't your adversary. They are a risk detective. They have one job: to build an airtight case that you are a reliable investment. If there are any holes in your story, any missing pieces to your income puzzle, they can't approve the loan. It's not personal, it's protocol. So your mission is to become the world's best financial storyteller, and your documents are the evidence that proves your story is true. The absolute foundation of this story, the bedrock of your entire case, is your federal tax returns. Lenders will almost universally require the last 2 years of your complete filed tax returns, all pages, all schedules. They aren't just looking at the number on the front page. They're going deep. If you're a sole proprietor or single member LLC, they're going straight to your Schedule C, profit or loss from business. This is where the great battle is won or lost for so many entrepreneurs. For years, your accountant's goal has been to minimize your taxable income. Every deduction, every business expense, every mile you wrote off was a victory against the IRS. But in the mortgage world, that victory can become your undoing. This is what we call the tax return trap. Lenders don't look at your gross revenue. They don't care if you invoiced $100,000. They look at your net income after all those glorious deductions. That $50,000 piece of equipment you wrote off, the home office deduction, the business travel, it all reduced your taxable income, and now it's reducing the income a lender can use to qualify you for a loan. That number on line 31 of your Schedule C? That is, for all intents and purposes, your salary. So the first step, long before you ever talk to a lender, is to review your last 2 tax returns. Look at that net income number. Is it a true reflection of the money you have available to live on? If not, you may need to strategize with your CPA about your next tax filing, potentially reducing deductions to show a higher net income, even if it means a bigger tax bill. It's a trade-off. A higher tax payment for 1 year in exchange for the keys to your dream home. Now, if you're a partner in a business or own an S-Corp, the underwriter will be looking for your K-1s and your business tax returns, like the 1120S. They'll analyze the health of the entire business, not just the distributions you took. They want to see that the business is profitable and stable enough to continue paying you. They are assessing the risk of the source of your income. But tax returns are ancient history. A 2022 tax return tells an underwriter what you earned 2 years ago. They need to know what's happening now. This is where the second critical piece of evidence comes in. The year-to-date profit and loss statement, or P&L. This document tells the story of your business from January 1st of the current year, up to the most recent month. It needs to be detailed. It should show your gross revenues, itemize your business expenses, and clearly state your net profit. And here's a pro tip. You should also provide a P&L for the previous full year. Why? Because the underwriter will compare them. They will lay your current P&L next to last year's tax return and look for one thing above all else: consistency. Or even better, growth. If your year-to-date net income is on track to meet or exceed what you showed on your last tax return, you're building a powerful case for stability. If it's declining, you need to be prepared to explain why. Maybe it's a seasonal business, and you can show P&Ls from previous years that demonstrate a similar pattern. The key is to leave no room for negative interpretation. So you have your tax returns, the history. You have your P&L, the present. Now you need the third piece, the proof. This comes from your bank statements. You will be asked for, at minimum, the last 2 to 3 months of statements for every single account you have, both business and personal. Every page, even the blank ones. The underwriter is performing an audit. They are cross-referencing everything. Do the deposits in your business bank account line up with the revenue you're claiming on your P&L? Is the money moving from your business account to your personal account in a consistent, predictable way that looks like a salary? Or is it erratic and messy? This is where so many applications get derailed. Large, undocumented cash deposits are a giant red flag. To a lender, a $50,000 cash deposit isn't a windfall. It's a potential undeclared loan from a relative, a cash under-the-table side job, or worse. Every large, non-payroll deposit will have to be sourced and explained. If your cousin paid you back $5,000 in cash for a loan, you'll need a letter from him explaining it, and potentially even proof of where he got the money. It's an invasive, exhaustive process. The cleaner your bank statements, the smoother your journey. Have a separate business account. Pay yourself a regular, consistent owner's draw or salary from your business account to your personal account. Make it look as much like a regular paycheck as possible. This demonstrates financial discipline and makes the underwriter's job easy. When you make their job easy, they are more likely to see you as a low-risk borrower. For gig economy workers, the DoorDash driver, the Upwork graphic designer, the Uber driver, you might not have a formal P&L. Your evidence looks a little different. Your tax returns and Schedule C are still king, but your supporting documents will be your 1099 forms from each company you work with. You'll also want to gather your annual earnings statements from those platforms. Show the underwriter the dashboard from the app that proves your consistent work and earnings. The more sources of income you have, the more organized you need to be. Create a spreadsheet that lists every 1099, the corresponding income, and ties it back to deposits in your bank account. You are creating the P&L that the platform doesn't give you. Once you've gathered all this evidence, 2 years of tax returns, a year-to-date P&L, and months of pristine bank statements, you need to package it perfectly. The final and often overlooked document is a masterstroke, a letter of explanation, or LOX. This is your chance to be the narrator of your own story. Don't wait for the underwriter to ask questions. Be proactive. Is your income seasonal because you own a landscaping company? Explain the seasonal trends in your letter. Did you have a huge dip in income 2 years ago because of a health issue, but have since recovered and business is booming? Explain it. Did you switch from a W-2 job as a software engineer to a freelance software consultant? Explain how you're in the same line of work, which demonstrates continued expertise and stability. This letter frames the narrative. It shows the underwriter you are organized, professional, and transparent. You're not hiding anything. You're guiding them through your financial life. Typically, lenders want to see a 2-year history of self-employment. This is the gold standard. But what if you've only been in business for 18 months? Is it a lost cause? Not necessarily. If you can prove you were in the exact same field, or even had a similar W-2 job for the 2 years prior, some lenders will make an exception. For example, if you were a staff accountant at a firm for 5 years and you've been a self-employed accountant for the last year and a half, a lender can see that as a continuous history of stable employment in the same industry. It's a stronger case than going from being a chef to a freelance web developer. By meticulously preparing your tax returns, P&L, bank statements, and a compelling letter of explanation, you transform that chaotic puzzle of self-employment income into a crystal-clear masterpiece. You've built an undeniable case for your reliability, not with a credit score, but with a mountain of cold, hard proof. You've satisfied the underwriter's need for a stable and predictable income history, but proving you earn the money is only half the battle. Now you have to prove you have the money for the down payment, and prove exactly where every single penny of it came from. That money is under an even more powerful microscope, and one wrong move, one unsourced deposit, can shatter the entire deal just days before closing. So let's talk about that microscope. Imagine this scenario. You're 2 weeks from closing on your dream home. You've done everything right. You've provided every pay stub, every utility bill. The underwriter has your life story on their desk. Then they point to a single line item on your bank statement from 47 days ago. A $5,000 deposit. You remember it clearly. You sold your old project car, the one you've been fixing up in the garage for years. A guy from 2 towns overpaid you in cash. You took that stack of bills, went straight to the bank and deposited it. You were so proud. That cash was the final piece of your down payment puzzle. But to the underwriter, that $5,000 is a ghost. It has no origin. It has no paper trail. It's what they call an unsourced deposit. And because you can't prove where that cash came from with a bill of sale and a copy of a check, the underwriter has to assume the worst. They have to assume it's a secret loan from a friend that you have to pay back. A loan that isn't on your application. A debt that could push your debt-to-income ratio over the limit. And just like that, because of a simple cash transaction, your entire mortgage approval can be denied. The deal is dead. This is the world of sourcing and seasoning your funds, and if you're applying with no credit score, this is the single most important financial battlefield you will face. These 2 words, sourcing and seasoning, are underwriter speak for proving 2 things: where your money came from and how long you've had it. Let's break it down. Sourcing is the paper trail. It's the detective work. You have to provide a clear, unbroken chain of evidence for every significant dollar that will be used for your down payment and closing costs. Seasoning is about time. Lenders need to see that the money has been sitting in your account, or seasoning, for a specific period, typically at least 60 days. Why? Because it proves the money is yours. It demonstrates stability. It shows you didn't just get a last-minute, off-the-books loan to temporarily inflate your bank account and trick them into approving you. Money that just appears out of thin air a week before you apply is the biggest red flag in manual underwriting. Your primary weapon in this battle is your bank statements. And when a lender asks for bank statements, they don't want a summary. They don't want a screenshot from your banking app. They want the full official multi-page statement that the bank generates each month. And here's a pro tip that trips up so many people. They need every single page. If your statement is 8 pages long but page 8 is blank or just has advertising on it, you send page 8. If you don't, the automated system or the underwriter will flag it as an incomplete document and kick it back to you, delaying the whole process. You'll need to provide, at a minimum, the last 2 full months of statements for any account you're using for the down payment. The underwriter is going to scan these statements for 2 main things. First, they're looking for any regular recurring payments going out that you didn't list as a debt on your application. A monthly $200 payment to John Smith could be an undocumented car loan. Second, and more importantly, they are hunting for those large unsourced deposits. Now, what's a large deposit? There's no magic number. It's relative to your income. If you make $10,000 a month, a $1,000 deposit isn't a big deal. But if you make $3,000 a month, that same $1,000 deposit is a third of your income. It's a flare in the night sky for an underwriter, and they will demand an explanation. So, how do you properly source a large deposit? You need documentation. Let's say your parents give you $10,000 to help with the down payment. This is incredibly common, but you can't just deposit it. This is called a gift fund, and it has a strict protocol. First, you need a gift letter. This is a formal letter signed by your parents that states their name, your name, their relationship to you, the exact dollar amount of the gift, and this is the most critical part, a sentence that explicitly says, "This is a bona fide gift, and there is no expectation of repayment." Without that exact phrase, it's not a gift. It's a loan. Second, you have to prove your parents actually had the money to give. Yes, you will need to ask your parents for a copy of their bank statement showing they had the $10,000 in their account before they gave it to you. Third, you need to prove the transfer. This means a copy of the cleared check, both front and back, or a wire transfer receipt. It's a 3-part chain of evidence: the letter, their proof of funds, and the proof of transfer. Miss any one of those and the money is invalid. What about other sources? If you sold a car, you need a copy of the title in your name, a signed bill of sale with the buyer's information and the price, and a copy of the cash check or wire receipt. No cash. If you took a loan from your 401k, you need the withdrawal statement from your retirement plan administrator showing the terms and the amount. If it was a tax refund, you need bank records showing a deposit from the U.S. Treasury, and a copy of your tax return to verify the amount. Every dollar needs a birth certificate. This brings us to the ultimate deal killer: cash. In the world of mortgages, cash is poison. It is untraceable. It is unsourceable. Lenders are legally obligated under federal anti-money laundering laws to be able to trace the origin of all funds. Cash breaks that chain instantly. I've seen heartbreaking cases where people have diligently saved cash for years, mattress money, stashing away $100 here, $200 there from side jobs. They show up with a shoebox full of $20,000, a lifetime of savings, and are told it's unusable. They can't deposit it into their account right before applying, because it will be flagged as a massive, unsourced deposit, and the entire amount will be disregarded by the underwriter. It's as if that money doesn't exist. So what's the strategy? How do you prepare for this intense scrutiny? The absolute best advice I can give you is to create a clean room account. At least 3 to 4 months, ideally 6, before you even think about applying for a mortgage, go open a new separate savings account at a bank. This will be your dedicated mortgage fund account. From that day forward, only clean, easily sourceable money goes into that account. Your direct deposited paycheck? Perfect. A transfer from your main checking account? Fine, because they can see the trail. A properly documented gift fund from a relative? Excellent. A transfer from selling stock? Great, you'll have the trade confirmations. What you don't put in that account is anything else. Don't deposit cash. Don't have your friend Venmo you $500 for their share of a vacation. Don't sell your old furniture on Facebook Marketplace for cash and deposit it. Keep this account pristine. It should contain nothing but funds with an unimpeachable paper trail. When it's time to apply, you give the lender the statements for this one clean account. The underwriter will look at it and see a simple, clean history of payroll deposits and maybe 1 or 2 other clearly documented transfers. Their job becomes 10 times easier. You look organized, responsible, and transparent. Remember, without a credit score, the underwriter is using your bank statements as a proxy. They are reading your financial biography. A traditional borrower with an 800 credit score might get a pass on a small, questionable deposit. You won't. For a manual underwrite, your financial discipline is on trial, and your bank statements are the primary evidence. Every transaction tells a story about your habits. A chaotic account with dozens of unexplained cash deposits and random transfers paints a picture of risk. A clean, organized account with meticulously documented funds paints the picture of a reliable borrower who manages their money well. The exact kind of person a lender wants to give a 30-year loan to, score or no score. Getting your assets in order isn't just a step in the process. For you, it is the process. But once your money is sourced, seasoned, and sitting pretty, you're ready to tackle the next giant pillar of your application. And that pillar is your income. If your assets are the foundation of your financial house, your income is the framing, the structure that proves it can withstand the monthly storm of a mortgage payment year after year. Without a credit score, the lender isn't just asking, "Can you afford this house today?" They're asking, "Can you afford this house for the next 360 months?" And the only way you can answer that question with a resounding yes is by proving you have stable, reliable, and documented income. This is where the paper trail becomes your best friend. Let's start with the golden rule of mortgage income: the 2-year history. This is non-negotiable. Lenders want to see a consistent 2-year track record of you earning money. Why 2 years? Because 1 year could be a fluke. A 6-month hot streak is just that, a streak. But 2 full years or 24 months demonstrates a pattern. It shows stability. It tells the underwriter that your ability to earn isn't a flash in the pan. It's a predictable, established reality. So, whatever your employment situation, your primary goal is to document an uninterrupted 24-month history of earnings. Now, how you document this depends entirely on how you get paid. Let's break it down, starting with the most straightforward scenario: the W-2 employee. If you receive a regular paycheck from an employer where taxes are automatically taken out, you're in the clearest position. The lender will typically ask for your last 2 years of W-2 forms, your most recent 30 days of pay stubs, and they'll likely call your employer for what's called a verification of employment, or VOE. They'll confirm your start date, your position, and your current rate of pay. The math here is simple. They take your gross monthly income, that's your income before taxes, and use that to calculate how much you can afford. If you get paid hourly, they'll average your hours. If you get bonuses or commissions, they'll want to see that 2-year history to consider it stable. A huge, one-time bonus last year won't count. A steady, predictable bonus every December for the last 3 years? That's income they can use. For the W-2 earner, the key is consistency. But I know a huge number of you watching this are not W-2 employees. You are the backbone of the new economy. The freelancers, the gig workers, the small business owners, the 1099 contractors. And for you, the income piece is more complex, but it is absolutely doable. This is where so many people without credit scores get tripped up, but you won't. For the self-employed, your tax returns are your Bible. You must have 2 full years of filed federal tax returns, all pages, all schedules. The lender isn't interested in your invoices or the gross deposits into your bank account. They are interested in one thing and one thing only: the net income you reported to the IRS after all your business expenses. This is the single most important lesson for any self-employed person seeking a mortgage. You cannot have it both ways. You cannot tell the IRS you only made $20,000 last year to minimize your tax bill, and then turn around and tell a mortgage lender you actually made $100,000. The number on your tax return is the number the underwriter uses. Period. They will take the net income from your last 2 tax returns, add them together, and divide by 24. That final number is your official, qualified monthly income. So, if you made $60,000 2 years ago and $80,000 last year, they'll add them to get $140,000, divide by 24, and qualify you with an income of about $5,833 a month. However, there's a catch. If your income is declining, say you made $80,000 2 years ago and only $60,000 last year, that is a major red flag. The underwriter will likely either use the lower, more recent income, or they may even deny the loan, fearing your business is failing. Consistent or increasing income is what they need to see. You'll also need to provide a year-to-date profit and loss statement, or a P&L, and often your last few months of business bank statements to prove that your income for the current year is on track to be the same or better than previous years. The takeaway is this: if you're self-employed, start planning 2 years before you want to buy a house. Strategize with your accountant about balancing tax write-offs with the need to show a strong, stable net income. What about other types of income? They all count as long as they meet 2 criteria. They are documented and they are likely to continue. Let's run through them. If you own other properties and collect rent, you can use that rental income. The lender will typically take the gross monthly rent and multiply it by 75%. That 25% reduction is to account for potential vacancies, maintenance, and other expenses. You'll need to show lease agreements and tax returns with Schedule E to prove it. If you receive Social Security, a pension, or disability payments, this is often considered excellent stable income. You'll need to provide the award letter from the governing agency that details your monthly benefit, and you'll show bank statements proving the direct deposit of these funds. Because this income is often non-taxable, some lenders can gross it up, meaning they might count it as being 15 to 25% higher than what you actually receive, to put it on equal footing with a W-2 wage earner's pre-tax income. What about alimony or child support? Yes, this can also be used as qualifying income, but the rules are strict. You must have documentation, like a divorce decree or court order, spelling out the amount and duration of the payments. And you must be able to prove you have received these payments on time and in full, for at least the last 6 to 12 months, typically through bank statements. Crucially, the payments must be set to continue for at least 3 years after your mortgage closing date. If your child is 17 and a half and the support ends at 18, you can't use that income because it won't have a 3-year continuance. Through all of this, remember the underwriter's mindset. Without a FICO score to tell them you're a reliable borrower, they are looking for predictability in its place. A steady job history is paramount. A 2-month gap in employment a year ago isn't a deal breaker, but you will absolutely have to write a detailed letter of explanation, or LOX, describing why it happened. Were you going back to school? Caring for a family member? Be honest, be concise, and provide documentation if you can. Changing jobs is okay, as long as it's a logical move, like a promotion or a move to a higher-paying job within the same industry. Hopping from being a chef to a truck driver to a web designer in a 24-month period looks erratic and unstable. To an underwriter, stability is more beautiful than a big salary. A registered nurse who has made a steady $70,000 a year for 5 years is a much stronger borrower in their eyes than a commission. Only salesperson whose income swung from $150,000 to $40,000 and back up to $120,000. Your income story is the narrative of your financial life. It needs to be clear, consistent, and easy to follow. Gather your W-2s, your tax returns, your award letters, and your pay stubs. Organize them. Scrutinize them. If you see a potential red flag, prepare your explanation before you're even asked. By presenting a solid 2-year history of stable, documented earnings, you are handing the lender the single biggest piece of evidence that you are a responsible person who honors their financial obligations. You're proving that you have the means not just to buy the house but to keep the house. You've now proven you have the cash, and you've proven you have the cash flow. But there's one final piece of the puzzle we need to put in place to truly replace the credit score. And that final piece of the puzzle is your documented financial character. It's the story of your reliability, told not through a 3-digit number, but through your real-world actions over the past 1 to 2 years. A credit score is, at its core, just a shortcut. It's a quick, impersonal summary of your payment history. When you don't have one, you don't get the shortcut. Instead, you have to write the long-form essay. You have to manually build the very thing a credit score is supposed to represent: a verifiable history of paying your bills on time. This is what the industry calls non-traditional credit, or an alternative credit history, and it is the absolute backbone of a no-score mortgage approval. You see, an underwriter's biggest fear isn't your lack of a FICO score. Their biggest fear is the unknown. The reason you don't have a score. Is it because you're a financial ghost responsibly living on a cash basis? Or is it because you're a financial phantom with a history of defaults and collections so bad you've fallen off the grid? Your job is to prove beyond a shadow of a doubt that you are the ghost, not the phantom. And you do this by building a portfolio of proof, a file so thick with evidence of your reliability that the underwriter has no choice but to see you as a safe bet. This file typically needs to show at least 3, and ideally 4 or more, accounts that you have paid on time every single month for the last 12 to 24 months. So what are these accounts? Let's break down the 4 pillars of a powerful alternative credit file. The first and most important pillar, the king of them all, is your housing payment history. Nothing, and I mean nothing, is more powerful to an underwriter than proof that you have consistently paid your rent on time. Why? Because it's the closest thing to a mortgage payment. It demonstrates you can handle a large, recurring housing expense without fail. If you've been renting from a large property management company, this is relatively easy. You can request a verification of rent, or VOR, from them. They're used to these requests and can provide a formal document showing your payment history, including the dates each payment was made. They'll want to see 0 late payments in the last 12 months. Not one. But what if you rent from a private landlord? A mom-and-pop owner? This is where you have to do the legwork. Your landlord's word alone isn't enough. You need objective proof. The gold standard is a record of canceled checks for the last 12 to 24 months. You can get copies from your bank. Each check is a time-stamped, undeniable receipt. If you pay via an app like Zelle or Venmo, or through direct bank transfer, you need to print out your bank statements and highlight every single one of those rent payments for the last 12 to 24 months. The trail must be crystal clear. The name of the recipient must match the landlord's, and the amount must match your lease agreement. You are building a case, and this is your star witness. A perfect rental history is non-negotiable. The second pillar is your utilities. This is the supporting cast that makes your story believable. We're talking about electricity, natural gas, water, and even your internet or cable bill. These companies don't typically report to credit bureaus unless you fail to pay, but they all keep meticulous records of your payments. You need to contact each utility provider you've used for the last 12 to 24 months and ask for a letter of reference or a payment history report. The customer service rep might not know what you're talking about at first, so you may need to be persistent and ask to speak to a supervisor. What you want is a letter on their company letterhead stating that your account has been opened since a certain date and has a satisfactory payment history with 0 late payments. Getting 3 of these from your power, water, and gas companies is a massive step forward. It shows you can manage multiple monthly obligations, a key indicator of financial responsibility. The third pillar, and one that people often forget, is insurance. Car insurance, renter's insurance, life insurance, even health insurance premiums. These are powerful because they are consistent, contractual payments. Just like with your utilities, you can call your insurance providers and request a letter verifying your policy has been in good standing for the last 12 or 24 months. Think about it from the underwriter's perspective. This person not only pays for their housing and their lights, but they also have the foresight and discipline to maintain insurance to protect their assets and their family. This paints a picture of a mature, low-risk borrower. It adds another layer of color and depth to your financial character. Now for the fourth pillar, the creative accounts. This is where you can really strengthen your file if you need more than the standard 3 or 4 sources. Think of any regular, documented payment you make. Do you pay for childcare or daycare every month? Get a letter from the provider and show the bank statements. Are you making tuition payments? That's a fantastic source. A monthly gym membership? A cell phone bill? Even streaming services like Netflix or Spotify can potentially be used if you can show a consistent 12-month history of automatic payments from your bank account. The key for all of these is documentation. A simple line item on a bank statement isn't enough. You need to pair it with an agreement or a letter from the service provider whenever possible. So let's put it all together. Imagine you are the underwriter. 2 files land on your desk. The first has a 640 credit score. It's okay but not great. The credit report shows a few credit cards and a car loan. It's a thin file. It doesn't tell you much. Then your file lands on the desk. There's no FICO score. At first, the underwriter is skeptical, but then they open it. Inside, they find a verification of rent from your property manager showing 24 straight on-time payments. They see a letter from your electric company, your water company, and your internet provider, all confirming a perfect 24-month payment history. They see a letter from your auto insurance company stating your policy has been paid on time, every month, for the last 3 years. And just for good measure, you've included a letter from your child's daycare showing a flawless record of 12 monthly payments. Which person seems like a better risk? The one with the mediocre, algorithm-generated number? Or the one with a thick file of real-world proof demonstrating impeccable financial discipline across every major area of their life? You've replaced a vague summary with an overwhelming body of evidence. You haven't just answered the underwriter's question. You've built an ironclad argument. This process takes time. You can't just decide to buy a house tomorrow and throw this together. It's a strategy that requires months, even years of deliberate action. Every bill you pay on time is another brick in the foundation of your future home. You are living your credit report day by day. So now we have all the components. We have the cash in the bank, proving your stability and skin in the game. We have the consistent, documented income, proving your ability to handle the monthly payment. And now we have this meticulously crafted portfolio of alternative credit, proving your history and your character. These three things together form a powerful trinity, a three-legged stool of financial qualification that is, in many ways, far more robust and telling than a simple credit score. You've built the perfect file. You've prepared the perfect case. But all this preparation, all this work is completely useless if you take it to the wrong person. Your perfect file will get rejected in minutes by a loan officer who only knows how to plug a social security number into a computer. Your next and perhaps most critical challenge is finding the right door to knock on. And this is where the game is won or lost. Think of it like this. If you have a rare heart condition, you don't go to your family doctor. They're brilliant for the common cold, but for this you need a specialist. A cardiologist who has seen your exact condition 100 times. In the mortgage world, 99% of loan officers are family doctors. They are trained to handle the 99% of cases that fit neatly into a box. You, with your pristine financial history but no credit score, are that 1% case. You are the rare heart condition. And taking your file to a standard loan officer at a big national bank is like asking your family doctor to perform open heart surgery. They don't have the tools, they don't have the training, and frankly, they're terrified of the liability. So why is the system built this way? It's simple: volume and speed. The mortgage industry, especially at the megabank level, is a factory. They want to process thousands of applications a day. The way they do that is with automation. An algorithm, a piece of software called an automated underwriting system, or AUS. The loan officer's primary job is to collect your data, your name, your income, your social security number, and feed it into this machine. The machine then connects to the credit bureaus, sees a score, sees a history, and spits out an answer: approved, referred, or denied. If you have no credit score, the machine sees an error. It sees a blank space where a number should be. To the machine, you don't exist. And so it spits out an instant denied. The loan officer gets the denial, shrugs, and tells you, sorry, the system said no. They have no idea how to go around the machine. For them, there is no way around the machine. The machine is the process. This is why your first instinct, to walk into the giant marble-floored branch of the bank you've had a checking account with for 10 years, is almost always the wrong one. They might know your name, they might give you a free lollipop, but their lending division is a completely separate, automated beast that does not care about your relationship. You are just a number, or in this case, a lack of a number. So who do you turn to? Let's break down the players and where you should be focusing your energy. First, let's talk about the maybe category: local community banks and credit unions. These are a significant step up from the megabanks. Why? Because their business model is different. They aren't always trying to immediately sell your loan to a massive investor like Fannie Mae or Freddie Mac. Sometimes they keep the loan on their own books. This is the magic word you need to listen for: portfolio loan. A portfolio loan means the bank itself is the investor. They are lending you their own money, and because it's their money, they get to set their own rules. They aren't slaves to the automated system. They have the ability to look at your file as a human being. They can perform a true manual underwrite. A loan officer at a credit union might actually walk your file down the hall to the underwriter's office and say, hey, take a look at this. This person has no score, but they have a huge down payment, zero debt, and a 10-year history of paying their rent on time. That's a conversation that will never, ever happen at a national megabank. So your local credit union or community bank is a solid place to start your search. But it's still a bit of a coin toss. Not all of them offer portfolio loans suitable for you, and you might still run into a loan officer who defaults to the standard process. This brings us to the yes category: the specialists, the cardiologists of the mortgage world. These are most often independent mortgage brokers. It is critical you understand the difference. A loan officer at a bank works for that one bank. They can only offer you the products that one bank has. They are a captive employee. A mortgage broker, on the other hand, works for you. They are a matchmaker. They don't lend any money themselves. Instead, they have relationships with dozens, sometimes hundreds of different wholesale lenders. These lenders are companies you've never heard of. They don't have public branches or run Super Bowl ads. They are behind-the-scenes giants that only work with brokers. And within that broker's network of 100 lenders, there might be 2 or 3 that specialize in exactly your situation. They have a department dedicated to manual underwriting. They have underwriters who do nothing but analyze files for people with no credit scores. A good mortgage broker knows this. They've seen your file type before. When you explain your situation, a light bulb goes on in their head. They don't see a problem. They see a specific solution. They'll say, oh, you're a no-score file. Perfect. I know exactly who to take this to. Lender A won't touch this. Lender B will deny it, but Lender C loves these files if we can document the alternative trade lines. That is the person you are looking for. The one who finishes your sentence. The one who doesn't say, "Let me check," but says, "Here's the plan." So how do you find this person? You can't just walk into an office. You have to become a savvy interviewer. You are hiring someone for the most important financial transaction of your life. You need to vet them. I'm going to give you the exact script, the questions you need to ask when you get a potential broker or loan officer on the phone. Do not deviate from this. Their answers will tell you everything you need to know in the first 5 minutes. When you call, after the initial pleasantries, you say this. Question number 1. I'm in a unique situation. I have a significant down payment and a high income, but I have no FICO score because I don't use debt. My question is, have you personally, in the last year, successfully closed a mortgage for a borrower with 0 credit score using manual underwriting? Listen carefully to the answer. The key words are personally and successfully closed. You don't want someone who says, "Oh yeah, our company can do that." You want someone who says, "Yes, I did one just a few months ago for a client just like you." If they hesitate, if they say, "I think so," or "I'd have to check with my manager," they are not your person. Hang up and call the next one. If they pass question 1, you move to question 2. That's great to hear. Can you tell me which wholesale lenders you work with that are best for this type of file? A true professional will answer this without blinking. They'll say something like, "For this, I typically look at UWM's manual underwrite program or maybe Rocket's. There's also a smaller portfolio lender I use that is fantastic with alternative credit." They know the players. If the person on the phone says, "Oh, we have lots of options," or "I can't really discuss specific lenders," that's a red flag. They're being vague because they don't know. They're a generalist trying to fake it. If they pass question 2, here's your final test, question 3. Excellent. In terms of building my file, what kind of alternative trade lines have you had the most success getting underwriters to accept? This is the kill shot. This question proves they understand the actual work involved, the stuff we talked about in the last part. The pro will immediately start listing things off. Oh, absolutely. We'll need 12 months of canceled rent checks or bank statements showing the payment. We'll get a letter from your landlord. We'll also want to see 12 months of utility payments, electric, gas, water. Cell phone bills can work, car insurance is a great one. We need to build a solid, documented 12-month payment history on at least 3 accounts. They'll be speaking your language. They'll be outlining the solution before you've even committed to working with them. That's your specialist. That's your guide. And be on the lookout for the giant waving red flag. If at any point in the conversation they say, "Well, the first step is to fill out an application so I can pull your credit," stop them right there. That is the ultimate sign of an amateur. They're falling back on their standard script. They heard "no credit," and their brain still defaulted to "pull credit." The correct approach, which a pro will suggest, is to do a pre-underwrite. They'll collect all your documents, your pay stubs, your bank statements, your proof of alternative credit, and review them before ever submitting a formal application. They build the entire case for you first so that when it finally goes to the underwriter, it's a slam dunk. Finding this person is 90% of the battle. You can have the most perfect, well-documented financial life, but if you hand that file to an amateur, it's worthless. It's like having a winning lottery ticket but losing it on the way to the store. Don't let that happen. Do the work up front. Make the calls. Ask the hard questions. Find the specialist. Because once you have that person in your corner, the entire dynamic shifts. You are no longer a problem file. You are a premium client. You are the kind of borrower lenders secretly love. No debt, big down payment, proven history of paying bills. You just need a translator. An expert guide who knows how to present your story in the language the system understands. You've now built your case and you've found your champion to fight for you. You've submitted the application. But it's not over. Your file is now on its way to the desk of the final gatekeeper. The person in a quiet office who holds the ultimate power to say yes or no. The underwriter. In our final part, we are going to pull back the curtain. We will show you exactly how an underwriter analyzes a manually underwritten file, the last-minute curveballs they can throw, and the single most important thing you must do after you get the approval to guarantee you make it to the closing table. So let's step into the shoes of that underwriter. Imagine your file lands on their desk. It's thicker than usual, filled with bank statements, letters from landlords, and utility bills instead of a simple credit report. What are they actually looking for? They're not trying to find a reason to say no, they're trying to build a case to say yes. They are looking for a story of stability and responsibility that a three-digit number fails to tell. Their analysis boils down to three core pillars, the same pillars used for any loan, but viewed through a different lens: capacity, collateral, and character. First, capacity. This is simple. Can you afford the payment? They will scrutinize your income with a fine-tooth comb. They'll look at your last 2 years of tax returns, your most recent pay stubs, and they will call your employer to verify everything. They're looking for stability. 2 years of consistent employment, preferably in the same job or at least the same industry, is the gold standard. If you've been jumping from job to job every 6 months, that's a red flag. They're calculating your debt-to-income ratio, or DTI. They take your total proposed housing payment, that's principal, interest, taxes, and insurance, and add it to any other monthly debts you have, like a car loan or a student loan. Then they divide that total by your gross monthly income. For a manual underwrite, they want to see this number stay low, typically under 43%. A lower DTI screams low risk. Second, collateral. This is the house itself. The bank is lending you hundreds of thousands of dollars, and the house is their insurance policy. This is where the appraisal comes in. An independent appraiser will assess the property to ensure it's worth at least what you've agreed to pay. The underwriter reviews this report meticulously. Is the value supported? Are there any health or safety issues? A leaky roof, a faulty electrical system, peeling paint in a home built before 1978. These are all things that an appraiser will flag, and the underwriter will demand they be fixed before the loan can close. The collateral has to be solid because if you default, that's all the bank has to recoup its investment. And third, the most important piece for you, character. Without a FICO score, this is where your alternative credit history becomes the star of the show. The underwriter is piecing together a mosaic of your financial habits. They want to see a minimum of 3, preferably 4, alternative credit lines with at least a 12-month history. They are looking for one thing above all else: consistency. Did your rent payment clear on the 1st of every month for the last year? Check. Was your electric bill paid on time every time? Check. Car insurance, cell phone, internet. They are building a timeline. And on that timeline, they are looking for one number: 0. 0 late payments in the last 12 months. A single 30-day late payment on your rent can be a deal killer. It tells them that even with your most important obligation, keeping a roof over your head, you faltered. They need to see a pattern of perfect, predictable, on-time payments. This demonstrates a low risk of default far better than a FICO score ever could. So the underwriter assembles this story: stable job, solid income, a house that's worth the price, and a proven year-long track record of paying your bills on time. When they can paint that picture, they can confidently stamp your file approved. But getting that approval isn't the finish line. The period between approval and closing is the most dangerous part of the entire journey. This is where dreams die, right at the 1-yard line. Underwriters can and do throw last-minute curveballs, often because the borrower made a critical, unforced error. Let's talk about the biggest deal killers. First, large, unsourced deposits. You're saving up for closing costs and your uncle gives you $2,000 in cash as a gift. You gratefully deposit it into your account. To you, it's a gift. To an underwriter, it's a potential undisclosed loan. It's a massive red flag for money laundering regulations. Every single large deposit that isn't from your payroll must have a paper trail. If it's a gift, you need a signed gift letter from the donor and proof the money came from their account. If you sold your car for $5,000 cash, you need a bill of sale and a copy of the title. Without that documentation, the underwriter will disregard those funds, which could leave you short for closing and torpedo the whole deal. The second curveball: changing your employment. You get a fantastic job offer mid-process. More money, better title. You take it. You've just thrown a grenade into your loan application. The underwriter has to re-verify everything. A new job means new risk. Is it in the same industry? Is it salary instead of hourly? Are you moving from a W-2 employee to a 1099 contractor? Any of these changes can cause the underwriter to deny the loan, even after the initial approval. The rule is simple: do not change jobs until after you have the keys to your new house in your hand. But the most common, most heartbreaking curveball is incurring new debt. You're approved. You're excited. You start shopping for your new home. You see a perfect living room set on sale with 0% financing for 24 months. Seems like a no-brainer. You sign the papers and the furniture store runs your credit. That single act can destroy your homeownership dream. Lenders do what's called a soft pull, or credit refresh, just days, sometimes hours before closing. They are specifically looking for new inquiries and new debt. That new $5,000 furniture loan just blew up your debt-to-income ratio. The DTI that got you approved at 42% is now 46%. The underwriter sees this, and at the 11th hour they issue a denial. The moving truck is booked, you've given notice to your landlord, and suddenly you have no loan and no house. It happens every single day. This brings us to the single most important thing you must do after you get that approval. It's not complicated. It's not difficult. But it requires absolute discipline. The moment you receive that clear to close from your lender, you must do absolutely nothing. Freeze your financial life in carbonite. Do not apply for any new credit. Not a credit card, not a car loan, not a stick of furniture. Do not make any large purchases, even with cash. Moving thousands of dollars around in your accounts right before closing makes underwriters terrified. Do not deposit any cash that you cannot meticulously document. Do not change your job, quit your job, or change how you are paid. Do not co-sign a loan for anyone, not even your own mother. Their debt becomes your debt in the eyes of the lender. Your one and only financial mission is to continue paying all your existing bills on time and show up to the closing table with a financial profile that is identical to the one the underwriter approved. You have to prove that the low-risk person they approved a few weeks ago is the exact same person signing the final documents. You have worked too hard to get here. You have meticulously saved, documented every penny, and proven your financial character without the shortcut of a credit score. You have navigated a complex system that is not built for you. To stumble at the very end because of a moment of impatience or a simple mistake is a tragedy. This journey, buying a home without a credit score, is the ultimate testament to financial discipline. It forces you to be better, more organized, and more responsible than the average borrower. You've had to prove what others get to assume. But in doing so, you've built a foundation of financial habits that will serve you for the rest of your life. You are not a ghost in the financial system. You are not invisible or unqualified. You were simply on a different path and you needed a different map. Now you have that map. You understand the process from start to finish. You know how to build your case, how to present your story, and how to avoid the pitfalls that stop so many others. This knowledge is power. It's the key that unlocks a door that millions of Americans believe is permanently locked to them. If this series has helped you, please share it. Share it with a friend, a family member, a coworker who thinks homeownership is impossible for them. You could change the course of their life. You have everything you need now. The path is clear. Go build your wealth. Go build your security. Go build your legacy. You've earned it.